Welcome back, everybody. Today, we're going to be diving into the world of high dividend ETFs in 2024.
Exciting stuff.
Yeah, you've probably seen the headlines, I'm sure.
Yeah.
These ETFs just exploded in popularity, and some are boasting some pretty incredible annual dividend yields over 10%.
Yeah, some big numbers.
Huge numbers. But our source is warning us
Oh,
about the dangers of chasing yield without looking at the bigger picture.
yeah, that's key.
So that sounds like a classic case of too good to be true, right?
It often is.
Yeah,
A high dividend yield doesn't automatically equal a great investment.
right.
To understand why, we need to kind of break down what annual dividend yield actually means.
Okay.
It's calculated by dividing the annual dividend payout per share by the current share price.
Okay.
Seems simple enough.
Yeah, it does.
But the catch is that a falling share price can artificially inflate that yield percentage.
Okay, so a lower share price means a higher yield, even if the actual dividend payout hasn't changed.
Exactly.
That's interesting because it seems counterintuitive. Usually we want the share price to go up, right?
Right. And in many cases, it will.
Right.
But sometimes that share price drops, and then you end up with a very high yield.
Okay.
A good example is TSDD,
Okay.
which is a double short Tesla ETF.
Okay.
It had a massive yield of almost 300%.
Wow.
But the reality is,
Oh.
its share price absolutely plummeted over the past year, going from $13.62 to just $1.30.
Wow. So it tanked.
It did.
So that huge drop made the yield look incredible.
Yeah.
Even if the actual dividend payout was tiny.
Exactly.
So it's like a mirage in the desert.
Yeah.
You think you've struck gold, but it's just an illusion.
Yeah, a classic dividend trap.
So what are some other red flags we should watch out for? It can't just be about avoiding low share prices, right?
Definitely not. You have to look at the big picture.
Okay.
The overall performance of the ETF and the underlying assets it's based on.
Okay.
Chasing just the highest yield can lead you straight into a dividend trap, where the high yield masks poor overall performance.
Right.
You might end up losing more in share value than you gain in dividends.
So our source analyzed some ETFs with yields over 100%.
Wow.
Some were duds, but others like QQQY and IWMY were potentially very profitable.
Interesting.
What made the difference between those?
Those two ETFs really highlight the importance of looking beyond just the yield.
Okay.
QNY, which is based on the cryptocurrency exchange, COIN.
Okay.
It did offer high dividends for a time,
Okay.
but ultimately it lagged behind Coin's overall growth.
Okay.
So even though investors were getting those high dividends, they were missing out on the potential for bigger gains by investing in Coin directly.
Okay. Interesting.
On the other hand, IWMY, which tracks the Russell 2000 index, actually did better than its underlying index thanks to its dividend strategy.
Wow. So QQQY had the high yield but missed out on growth while IWMY had a solid yield, and D outperformed the market it was tracking.
Exactly.
Sounds like diversification is key here.
It is.
Spreading out your investments across different types of assets can help balance out those risks and rewards. Speaking of different types of assets, our source mentions quite a few other high dividend ETFs with some interesting strategies.
Yeah, there are a lot out there.
Where should we start?
Well, there are several categories worth exploring.
Okay.
First, we have the yield max ETFs, which use option strategies for high volatility stocks like Coin, NVDA, TSLA, SKU, and Meta.
Option strategies. That sounds a bit more complex.
It can be.
Can you break that down for us?
Sure.
What exactly are they doing with options to generate those high dividends?
So yield max ETFs utilize a strategy called covered call options.
Okay.
It's a way to potentially generate higher income,
Okay.
but it also limits the potential for big gains if the stock price skyrockets.
Okay, I see.
Basically, the ETF sells call options on those underlying stocks,
Okay.
which gives them an upfront payment called a premium.
Okay.
This premium contributes to those high dividend payouts.
So they get cash up front,
Exactly.
and that can go right to the investors.
Right to the investors as dividends. However, if the stock price goes above a certain level,
Oh.
the ETF is obligated to sell the stock at that predetermined price.
So they could miss out.
They could miss out on further gains if the stock continues to rise.
So it's a trade-off.
It is.
More consistent income from those premiums.
Yeah,
But less opportunity to ride the wave if the stock really takes off.
exactly.
What about investors who aren't comfortable with that level of risk?
Yeah, that's understandable.
Are there any options for them in the high dividend ETF space?
Absolutely. There are options-based ETFs that track major indices like the S&P 500,
Okay.
NASDAQ 100, and Russell 2000, as well as a China-focused index.
Okay.
By selling options on these indices, these ETFs aim to generate income while still providing exposure to the overall market.
That sounds like a good middle ground.
It could be.
Some income potential from those option premiums, but also the potential for growth if the overall market performs well.
Yeah, you get a little bit of both.
Did any other specific ETFs stand out in the research?
Two others worth mentioning are BITO and WDTE.
Okay.
BIO is the first U.S. Bitcoin-linked ETF.
Interesting.
And while it doesn't hold actual Bitcoin,
Okay.
it tracks Bitcoin futures contracts.
Okay.
Its dividend growth in 2024 was pretty remarkable.
Wow.
On the other hand, WDTE offered high dividends,
Okay.
but ultimately lagged in performance because the S&P 500, which it's based on, declined.
Oh, so even with those high dividends, it still lost money
It did.
because the underlying asset went down.
Exactly.
It seems like understanding how those underlying assets will perform is just as important as the dividend itself.
It's crucial.
What are some of the broader trends we're seeing with these high dividend ETFs?
One key trend is that in a strong market like we saw for much of 2024,
Yeah.
only a handful of high dividend ETFs consistently beat their underlying assets.
Oh, wow.
This highlights the inherent risks involved,
Okay.
especially if the market takes a downturn.
Right.
Another factor to watch out for is share consolidation.
Okay, so even in a good market, high dividend ETFs aren't always the best performers.
Right.
And we need to be aware of potential pitfalls like share consolidation.
Definitely.
It seems like due diligence is absolutely critical when evaluating these ETFs.
Couldn't agree more.
But before we jump into that, I'm curious about those yield max ETFs and their option strategies.
Yeah, happy to talk more about that.
Can you walk us through how those work in a bit more detail?
Let's do it.
Let's dive a bit deeper into those yield max ETFs and their covered call option strategy.
Okay.
It sounds like they're selling the right to buy a stock at a certain price.
Right.
But what does that have to do with generating dividends for the ETF holders?
It's all about those premiums I mentioned.
Okay.
Imagine the Yield Max ETF holds shares of, say, NVDA,
Okay.
and they believe the price might stay relatively stable for the next month.
Okay.
They can sell a call option to someone else,
Oh.
giving that person the right to buy their NVDA shares at a specific price within that month.
Gotcha.
In return for that, right, the option buyer pays the ETF a premium.
Okay.
That premium is immediate cash for the ETF, which can then be distributed to you as a dividend.
So it's like they're making a bet that the stock price won't go above that set price.
Yeah,
And they're getting paid for that bet up front.
exactly.
And if they're right, they keep that premium and distribute it as dividends.
Uh-huh.
What happens if they're wrong and the stock price goes way up?
That's the trade-off.
Okay.
If the stock price goes above the agreed-upon price, called the strike price,
Okay.
the ETF is obligated to sell their shares to the option buyer at that lower price.
Oh, so they miss out on the gains.
They miss out on those additional gains.
Okay.
This is why covered call strategies are better suited for generating income rather than aiming for massive growth.
So it's a more conservative approach.
Yeah.
Within the world of high dividend ETFs,
Yeah.
you're giving up some of the upside potential to get more consistent income.
Exactly.
Makes sense.
Yeah.
Our source also mentioned options-based ETFs that track major indexes like the S&P 500. Is
Yeah.
the strategy the same there?
It's very similar. Instead of individual stocks, these ETFs sell call options on the entire index.
Okay.
It's like betting that the overall market represented by that index won't surge past a certain point.
Gotcha.
It's generally considered less risky than selling options on individual volatile stocks,
Right.
but it still carries the same trade-offs.
So if someone is looking for a high dividend ETF but wants to avoid those individual volatile stocks
Yeah.
like Tesla or NVDA, these index-based options, ETFs could be a good alternative.
They could be. It really depends on your risk tolerance and investment goals.
Of course.
If you're prioritizing steady income and are comfortable with potentially limited growth,
Okay.
these types of ETFs might be a good fit, but it's important to remember that no investment is without risk,
Right.
and thorough research is always crucial.
That's a great point. It's all about finding the right balance for your individual needs.
Absolutely.
Speaking of research, what other factors should we be considering when evaluating these high dividend ETFs?
Well beyond the dividend yield itself, you want to scrutinize the ETF's overall performance history.
Okay.
Look beyond just the past year. How has it performed in different market conditions?
Okay.
Has it consistently delivered on its dividend promises?
So past performance isn't a guarantee of future results, but it can give us some clues about the ETF's strategy and resilience, right? What else should we be digging into?
Fees are always important.
Yeah.
Every ETF has an expense ratio, which is the annual fee you pay to the fund managers.
Okay.
Make sure the expense ratio is reasonable, as high fees can eat into your returns over time.
And since we're talking about minimizing risk, diversification is probably important too, right?
Absolutely.
We don't want to put all our eggs in one basket.
You don't want to do that.
So check how diversified the ETF's holdings are.
Right.
Is it heavily concentrated in just a few sectors or companies?
Yeah,
Or does it offer broader exposure across different areas of the market?
that's what you want. Greater diversification can help mitigate risk, especially if one particular sector or company experiences a downturn.
That makes sense. Spreading out the risk across different assets can help buffer against those inevitable market swings.
Yeah, it's all about managing risk.
You mentioned share consolidation earlier as something to watch out for.
Yeah,
Can you explain that in a bit more detail?
sure. Share consolidation is when an ETF combines multiple shares into one.
Okay.
Imagine you own 10 shares of an ETF,
Okay.
and each share is worth $10.
Oh, okay.
Then the ETF consolidates its shares,
Oh, okay.
and those 10 shares become one share worth $100.
Okay.
The overall value of your investment hasn't changed,
Gotcha.
but the number of shares you hold has decreased.
Okay, so it's a cosmetic change.
Yeah.
But how does it affect the dividends?
While share consolidation might make the individual share price look more appealing,
Okay.
it can actually lead to a decrease in your overall dividends.
How so?
Let's say the ETF was paying a $1 dividend per share before consolidation. You had 10 shares, so you're receiving $10 in dividends.
Okay.
After consolidation, you have one share, but the dividend payout might not increase proportionally.
Always.
It might still be $1 per share, meaning you now only receive $1 in dividends.
So even though the yield percentage might stay the same, the actual dollar amount you're receiving in dividends could decrease because you have fewer shares.
That's right.
That's a really important detail to pay attention to.
It highlights the fact that you can't just focus on the yield number in isolation.
Right.
You need to understand the ETF's underlying strategy,
Okay.
its holdings, and how those holdings might react to various economic conditions.
Speaking of economic conditions, we talked earlier about how a declining S&P 500 hurt WDTE's performance even though it had a high dividend yield.
Right.
What other external factors could impact these high dividend ETFs?
One major factor to consider is interest rates.
Oh.
But interest rates rise significantly, it could impact both the stock market and the ETFs themselves.
Oh, wait.
Rising interest rates generally make borrowing more expensive,
Okay.
which can slow down economic growth and potentially hurt company profits,
Uh-oh.
leading to lower stock prices.
And if stock prices decline, those high dividend yields might start to look less appealing, right?
That's why.
Because even a high dividend payout might not offset the overall loss in value.
Precisely. It's a delicate balancing act.
Right.
On the other hand, some high-dividend ETFs,
Okay.
particularly those utilizing option strategies,
Okay.
might actually benefit from increased market volatility,
Interesting.
which can sometimes accompany interest rate hikes.
So it's not a one-size-fits-all situation.
Definitely not.
Some ETFs might be more resilient to interest rate changes than others.
Right.
It seems like understanding the potential impact of interest rate changes is crucial when evaluating these ETFs.
It's a key factor.
Our source didn't specifically dive into the interest rate question,
Okay.
but they did stress that relying solely on the annual dividend yield can be misleading.
Rightly so. It's tempting to chase those flashy high yields.
It is.
But it's essential to remember they're just one piece of a much larger puzzle.
So, listener, we've covered a lot of ground here.
We have.
We've talked about the potential benefits and risks of high-dividend ETFs, the importance of looking beyond just the yield, and the need to carefully evaluate an ETF's strategy holdings and overall performance.
For sure.
But before we wrap things up, I'd love to get your final thoughts on those Bitcoin-linked ETFs like BITO
Yeah.
and what the future might hold for them in this dynamic market.
Yeah. Happy to share my thoughts.
BITO certainly had a roller coaster ride in 2024 with Bitcoin's price swings.
Oh, yeah.
Do you think that kind of volatility is something investors should expect going forward if they're considering a Bitcoin-linked ETF?
Yeah, I think volatility is pretty much baked into the Bitcoin pie at this point.
Yeah.
It's a relatively new asset class, and its price is driven by a complex mix of factors,
Right.
from technological advancements to regulatory changes to plain old speculation.
Yeah.
So yes, anyone considering a Bitcoin-linked ETF, whether it's BITO or something else, should be prepared for a potentially bumpy ride.
That makes sense. High risk, high reward, as they say.
Exactly.
But with BITO specifically, it's important to remember it's not actually holding Bitcoin.
Right.
It's holding Bitcoin futures contracts.
Yeah.
How does that difference affect the ETF's performance and those dividend payouts?
It's a crucial distinction.
Okay.
Futures contracts are agreements to buy or sell an asset at a predetermined price in the future.
Right.
So BITO is essentially betting on the future price of Bitcoin,
Okay.
not the current price.
Gotcha.
This adds another layer of complexity and risk,
Okay.
as those futures prices can fluctuate even more wildly than the spot price of Bitcoin itself.
So those impressive dividend payouts we saw from BITO in 2024 were driven by the ETF making the right bets on the
Yeah.
future price of Bitcoin.
Exactly.
And if those bets had gone the other way, the dividends could have been much lower or even non-existent.
That's right. It goes both ways.
It sounds like investing in a Bitcoin-linked ETF requires a certain level of risk tolerance
Yeah,
and a deep understanding of how these futures markets work.
definitely.
It's not for the faint of heart or
Right.
for those just chasing high yields without understanding the underlying mechanics.
For sure.
I think that's a good note to end on.
Yeah,
We've talked a lot about the allure of high dividend ETFs,
we have.
and we've seen some compelling examples of how they can potentially generate significant income.
Yeah, for sure.
But we've also uncovered the crucial importance of looking beyond the yield,
Right.
understanding the underlying assets and strategies, and carefully evaluating your own risk tolerance and investment goals.
Couldn't have said it better myself.
Well said. It's been a fascinating journey through the world of high dividend ETFs.
It has.
We've learned about annual dividend yields, uncovered those tricky dividend traps, and explored the importance of thorough due diligence.
That's right.
Remember, listener, high dividends don't always equal high returns,
Yep.
and understanding the full picture is crucial to making smart investment decisions.
Couldn't agree more.
Until next time, happy investing, everyone.